All right, everybody, welcome to week 18 of Selling Weekly Lottos. Every week I sell what's the equivalent of lottery tickets to gamblers by using options in the stock market, and that's how I make passive income. All right, every week we do the disclaimers. Number one, all my positions are covered and I don't use margin. Using margin, you can blow up your account and owe someone money. I don't want to do that, so I just use my own money. Number two, I'm totally okay with selling my shares or buying the shares if my contracts get assigned. If you're uncomfortable with the idea of selling your shares or having to buy the shares, don't write options on them. And then number three, I'm really sorry to say this, guys, but this is not free money. Some people call this free money, even in the communities associated with option selling. But to me, it's not free. There's a risk. And the reason the premiums are so high is because you're taking the risk. Now that deserves payment. All right. That being said, the winner this week is me. I made $1,106 using $137,500 in collateral. That's a 0.8% yield. All right, let's take a look at the positions. Pew, pew, pew. First one, BitX, 65 call. I sold that for about $420, bought it back for $40. That's about a $380 gain. iBit, 70 call. I sold that for about $380, bought it back for $90, and that's about a $290 gain. Last one, Meta, 740 call. Sold that for about $500, bought it back for $65, and that's about $435 gain. All right. One important note, and we'll talk about this in this video, is the stocks did end up going lower than the amount that I got in options premium. So some people would call this an account value loss, an overall loss. But I'll let you know how I interpret that as an income strategy later in the video. First thing, let's take a look at the charts and my thought process of why I decided to do this. All right, so bazam! All right, so this one's a little bit different this week. All right, last week I showed you both the stocks fell and I sold covered calls, but this week the opposite's happening. Both the stocks are having opposite moves. One's pumping, one's dumping, right? But the same thing kind of applies. So the reason these options have value, like I talked about last week, is from the implied volatility. So because of these huge moves, the options premiums are going to be higher. So in the case of the iBit position here, iBit went from like 60 up to 67, right? So the options market isn't predicting this is going to run out of steam. It's not thinking. The options market is just taking what's happening and expecting more of it, right? So in this case, iBit is pumping and the options market is expecting, is pricing in that iBit could keep going. And that's why the options are worth more, okay? And then in the case of Meta, you would think that it's the opposite, but it's actually kind of the same. Because it's dumping, the options market is thinking, well, it was just at 740, so it could go back there. So the price of the 740 calls is still inflated with implied volatility because it was just there and it could go back, okay? So that's where I step in and I'm thinking, hey, iBit might run out of steam here, and hey, Meta could also just stabilize here. All right. So let's think about it this way. Let's use a hypothetical. Let's say iBit was at 67 for the past week, and it stayed at 67 the whole week. Those 70 calls wouldn't have much premium, not for the next week at least, because the market hasn't seen anything to make it think that it could go to 70. So So that's why the 70s are worth more when it goes from 60 to 67 than when it goes from 67 to 67. And then the same thing for Meta. If it was 720, this is hypothetical, if it was 720 and it stayed there for the whole week, the 740s wouldn't have much premium because there's no like signal there. There's nothing that shows the market that it could go to 740. So because it was just 740 and it dropped, that's why the option market thinks that the 740 should have more premium. All right. Let me show you why I chose the specific strikes. So for IBIT, we have to go back a little bit, and I'll show you all the way back in August. This is the same chart, it's just zoomed out. All the way back in August, IBIT went to 70 as the peak. All right. So I chose 70 because I thought, hey, if it goes past 70 this time, I'll sell the shares. It looked like it had a hard time last time. So let's see if it can go past it. And it actually did go past it, but then it came back down. So, and then for Meta, I was looking over at, and I put the horizontal line there, that 745 is around where it started doing that big downward move. So I'm thinking 745 is the resistance. So I chose the 740 call. And it just so happened that 740 call was around the $500 I want to make per week too. So it kind of worked out. All right. Let's pull back with both charts up. Now you can see with the yellow trajectory line, now remember, this is not technical analysis. I'm not predicting the price. The yellow line is simply the point where I sold the option, the price in the day that I sold the option, and the price in the day that it expires. All right. So everything was going all right, following my trajectory until the last day, where you can't predict that there's going to be a tariff tweet. Okay. So actually the best move would have been to just sell my shares outright. But a couple of weeks ago, I sold my shares, and everything pumped after. And this week I didn't sell my shares, and everything dumped after. So, hey, these things happen in the market. All right. So, but let's talk about the question I get asked most, which is, why do you buy the contracts back? Why don't you just let them expire? I get this question at least once a week, every week, and it's very simple for me. I think that the value of the next contract is worth more than the value of the current contract, especially if it's the last day. All right. So let's take a look at the option chain for Meta. Boom. All right. So you can see here. All right. I bought the 740 calls back for $65. Right. But let's focus in on these 750 calls. 750. So on the day of expiration, those 750 calls, they're worth $8. But the next week, they were worth $500. All right. So take 5 to 10 seconds and decide which one would you rather sell. All right. Time's up. I hope you got a quick answer. I'm choosing the $500 premium for next week. Okay. If you chose $8, I'm sorry, man, but $8 can't even buy you half of a 6-inch Subway sandwich anymore. Okay. You go to Subway and you ask for a 3-inch, and you wave your $8 around, they're gonna say no. Okay. Not even 3 inches of sandwich for $8. All right. I'm choosing the 500. And that's what I did, actually. So let's go ahead and see. Hoya! So you can see here, I actually sold the 750 call for next week, and I made $221. I did a day trade on that. All right. So I would have made 65 if I let the option, the 740 call for October 10th expire, but instead I made $221 for the October 17th 750 to expire. Now, it was a special case last week last Friday because the whole market tanked, right? So I got 40% returns on that in one day. Normally I would hold it, but because the option got more gains in like 2 hours than it would for like 4 days, I decided to take the profits, all right? And I can't include it in this week because the option was for next week, and I can't include it next week because I traded it this week. So it's kind of just in like in profit purgatory. Anyway, it's not going to be included. So, but it's just an example, right? But even without the market dumping, I still would have found more value in the next week's contract than letting my option expire today. And also, even if the market didn't dump and it pumped instead, I would have made an extra 1,000 from selling my shares at 750 instead of 740. All right. So also, that's not all. I don't always sell the contract for next week immediately. There's two other choices. You can also hold, which is you're probably, if you're holding and you don't sell the contract, I'm thinking that the shares could explode upwards, not just a slow upward move like a breakout. And then you could also sell your shares outright, which is usually I'll think that either the stocks are going down, but you could also just want the cash if you sell your shares. All right. So last thing I want to talk about, I know it's a longer video this time, but I do want to talk about this because it's important, is unrealized losses. So some people might say that I lost money this week because the shares went down more than the price that I got for the options. So it was a net loss. And that's true if you're a trader. If you're doing this as a short-term trade, it would be a loss. But because I'm doing this as an income strategy with a little bit of investing, I interpret it a different way. So the way I think about it is this collateral, these shares, this cash, I think of them as my employee. All right? Let's take Meta for an example. These 100 shares that I got for $720 each, $72,000. This is a $72,000 employee of mine that turned into shares, okay? With these shares, around $720 to $730, I could make my goal of $500 a week by selling 740 or possibly even 750 calls. So I could sell those calls for $500 a week and potentially make a $2,000 or $3,000 profit by selling the shares. All right. By the end of the day on Friday, it was around 700 to 710. Even at that price, I could sell the 725 or 730 calls for $500 a week. But this time, if I have to sell the shares, I would only get a $1,000, maybe a $500 or $1,000 profit on the shares, right? Let's say it starts going down to the 650 range. At that point, it's probably not even going to be weekly income anymore. I'll probably have to switch to monthlies, and I'll be lucky to even get $1,000 a month, and that'll be at the same cost basis I bought the share. So I'll be lucky to get $1,000 and even to sell the shares at break even. Let's say it goes even lower. It starts going into the 500 range. At that point, I become a long-term investor. It's dead money now. It's not going to be worth it for me to sell calls on it at my cost basis. I'll have to sell calls on it for a loss, which I don't want to do. So I just become a long-term investor, and I'm just going to hold it for a long time. I just become like the traditional investors, buy and hold. All right. So in the bad case, in this strategy, you become just a long-term investor. All right. And that's why I bought Meta in the first place. All right. The worst possible case is Meta becomes like Blockbuster or BlackBerry. And at that point, I'll probably let it go for a big loss. But that's just the risk of investing, guys. That's a chance you're always going to take, is that Meta could become the next Blockbuster. Who knows? You know, it could happen. Like, if it happened to Blockbuster, it happened to BlackBerry, it could happen to Meta. We don't know what's going to happen in 10 years. But the more important thing is in the short term, I don't see this unrealized loss. I don't even see the unrealized gains. Even when it was at 735, I wasn't thinking of it as $1,500 gains. I was thinking of it as now I can sell 750 calls for $500 instead of 740 calls for $500. And now that it's at 700, I'm thinking, oh, I have to sell 725 calls for $500, right? So the unrealized gain or loss isn't like that much of a consideration for me. The price that it's currently at just changes the parameters of what the future collateral could be used to make income, right? So it changes how much income I can make and the prices I have to sell the shares, the covered calls at. That's pretty much it. So last thing, let's do a really quick look at my benchmarks. Hoya! All right, so one thing I realized this week is that there's a major flaw in my benchmarks. Despite what I just talked about literally 5 seconds ago about unrealized gains not really mattering that much to me, it is still disingenuous to not include it. So think about this. If Meta and Bitcoin went down 50% last week, I would have lost $60,000 in unrealized gains, but my spreadsheet would have just shown me making $1,000, right? So that's wrong. So I need to figure out a way to show the unrealized results without affecting the sheet too much. So I just to let you know that is something I have to work on, which I'll hopefully show you by next week. All right, but for the time being, let's quickly look at the benchmarks right here. $25,500 I made in 18 weeks. That's an average of $1,400 a week, $1,400 a week. And I've only been using an average of $125,000 or so. That gives me an average weekly yield of 1.14%. What that's leading to is a potential of a projected income of almost $74,000 a year, and that's almost 59% estimated APY, annual percentage yield. Tell me where you're going to get 60% on anything else, all right? The total yield is almost 20.5%, all right? And this is probably the most important metric right here because S&P 500, I started this on June 9th, okay? June 9th to October 10th, my results for this small subset of my account is 20.5%. Meanwhile, S&P 500 is 9%. NASDAQ is at 11%. So I'm beating index funds by double. And that's really important to me because normally, if you talk to normal buy and hold traditional investors, everyone says that these option selling strategies underperform the market. So my results right here are showing that this can actually outperform the market. Now, you'll outperform the market with this when you make good decisions. So that's one of the reasons I'm really grateful that people are watching my videos, because I think because I'm taking these videos and posting these results, I'm making better decisions than I normally do. And the accountability is leading to better trades, and that's actually giving me better results than what I normally get. So just want to say thanks. Thank you for watching these. Thanks for posting comments and questions, and thanks for subscribing. It's really motivating me even more so I don't come into the next video telling you how I blew up my account. All right. Anyway, you guys take care. I'll see you again next week. Peace.